Canadian home prices rose in July from June to hit a record high for the third consecutive month, but the slower pace of gains and falling prices in Vancouver added to recent evidence the market is cooling. I'm joined down the line today by Benjamin Tal, Managing Director of CIBC World Markets in Toronto, to get his verdict on the new laws surrounding mortgage rates and what will happen to the market. Mr. Tal, thank you for joining me. The real estate market is said to be showing signs of cooling. Would you agree? And if so, what are these signs?
Yes, actually, after 10 years of a boom period, the Canadian housing market is slowing down. We are seeing it in resale activity. We are seeing it in prices that are starting to fall, especially in British Columbia, but also starting in Ontario and elsewhere. So there are very clear signs that the Canadian housing market is slowing down. It is not collapsing. It is not crashing by any stretch of the imagination. It is simply slowing down after a period of more than 10 years of rising at a very rapid pace.
Finance Minister Jim Flaherty has reduced the rate of new government-insured mortgages to 25 years from 30. This was the fourth time in as many years the minister has tightened mortgage rules. What effect has this change had on the market and the Canadian economy?
Yes, it was not a secret that the Bank of Canada and the Finance Minister were very concerned about house prices and the fact that maybe house prices are overshooting, and they are very correct to be concerned about this issue. Having to deal with a situation in which interest rates cannot rise due to what's going on in the economy elsewhere and, of course, the global economy, the finance minister had no choice but to intervene directly in the mortgage market by making it a bit more difficult for marginal borrowers to actually enter the mortgage market. Those four changes played a significant role in slowing down the housing market over the past year or two, and that's actually a very positive development because it is not really killing the market. It's not impacting the overall market. It's really impacting marginal borrowers, people who are not supposed to be in the market, and that's exactly what we are seeing. So the change in amortization was the right thing to do. It's basically raising interest rates without raising interest rates. It's really making it more difficult for people at the margin to borrow, and that's exactly what we need to see. I estimate that those changes probably reduced mortgage outstanding growth, by roughly 2 percentage points, which is not insignificant, but I think it's a very, very positive step in the right direction.
I see. And why has home equity debt grown so dramatically recently?
Well, we have to remember that interest rates have been extremely low and have been going down for more than a decade now, so people have been taking advantage of extremely low interest rates in order to borrow, and that makes sense. That's basically a very logical way of using interest rates to your benefit. The question is whether or not it's too much of a good thing, and that's what the Bank of Canada and that's why the Finance Minister is telling us. Basically, be careful, don't overdo it, and that's why they made those changes. So it was all in a response to low interest rates. And again, we have to remember that the rest of the economy was not doing great, so the consumer was basically taking over. Canada is the only country that saw actual credit growth rising during the recession, because this was not a made-in-Canada recession. Canada, in many ways, was basically a second-hand smoker, and the consumer was able to bail out the economy, which was a good thing during the recession. But now it's time to slow down, and we are seeing non-mortgage credit slowing down dramatically. It's almost zero, and even mortgage credit is starting to slow down, probably with the help of what the Finance Minister did recently.
Lastly, what do you see for the future of house and mortgage prices in Canada, and what is the likelihood of a housing market correction?
Well, there is little doubt that the housing market in Canada is overshooting, regardless where you live. It means that house prices will fall. They probably will fall by 10, maybe 15% over the next year or two, depends where you live. This is not a crash. This is an adjustment from an elevated level, maybe too elevated level of activity, and that's exactly what all those changes are designed to achieve, a soft landing in the housing market. I do see house prices falling. It's not going to be pretty in some pockets, but that's exactly what we need. So the housing market of tomorrow will not be as exciting as the housing market of yesterday. I see a stagnating market with the potential for price decline over the next year or two.
Thank you, Mr. Tal, for joining me today. For more interviews, insights and updates, just click back to the Dukascopy website.